I mean, if you've owned gold, which we have, for some time, then these last 2 years have been good to you, and especially the last 12 months. We own the miners too, but the miners, we trade those get expensive sometimes. They're not that way now, but they can get really expensive, and you don't want to keep those. The bullion we hold all the way through, all the way. We keep it all the way. And I think people forget about that from a currency standpoint. Once the dollar is going to be declining, and the dollar's declined really forever buying power wise, you look at the last 25 years. But if you think the dollar is going to be declining, and I think it will be, I think all of these other countries want to sell the dollar. They want to buy gold. They don't want to put it in the dollar or the assets in the U.S. because they don't trust us.
Right.
And so they'll be buying more gold. And
the gold market's remarkable surge to all-time highs is reshaping the mining sector, with Barrick Gold, the world's second-largest gold producer, reporting a strong start to the year. Higher gold prices largely drove the company's solid financial performance, with an average gold price of $2,898 per ounce during the first quarter, a 40% increase from the previous year. Despite a 19% drop in gold production, which came in at 758,000 ounces, Barrick's performance was nonetheless robust. TedOakley, founder and managing partner of Oxbow Advisors, notes that gold remains a preferred long-term hedge against the weakening U.S. dollar. At the same time, miners, due to their volatility, are better suited for short-term trades. A decline in the U.S. dollar's value has largely influenced this ongoing shift in the gold market, with trust in the U.S. dollar declining. As a result, many countries, especially in Asia, are seeking to reduce their exposure to the dollar and increase their gold holdings. China, for instance, has been consistently expanding its gold reserves. In April, the People's Bank of China increased its gold holdings for the sixth consecutive month, adding about 70,000 troy ounces. Over the past 6 months, China's gold reserves have grown by nearly 1 million ounces or 30 tons. This push to increase gold holdings reflects a broader trend among central banks to diversify away from the dollar in response to economic uncertainties, including the ongoing trade war. The rally in gold prices this year, which has seen a nearly 30% increase, is also being fueled by rising investment demand, as concerns about U.S. assets and financial instability continue to grow. With central banks globally accumulating more gold, this surge underscores the precious metal's status as a safe haven in a volatile economic environment. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I mean, if you've owned gold, which we have, for some time, then these last 2 years have been good to you, and especially the last 12 months. We own the miners too, but the miners, we trade those get expensive sometimes. They're not that way now, but they can get really expensive, and you don't want to keep those. The bullion we hold all the way through, all the way. We keep it all the way. And I think people forget about that from a currency standpoint. Once the dollar is going to be declining, and the dollar's declined really forever buying power wise, you look at the last 25 years. But if you think the dollar is going to be declining, and I think it will be, I think all of these other countries want to sell the dollar. They want to buy gold. They don't want to put it in the dollar or the assets in the U.S. because they don't trust us. I think for somebody that wants to hedge, if you want to own treasury bonds, for example, you probably should own a little bit of gold too at the same time. But it feels as though that's what's happening in the marketplace right now. If we were looking for a price to come to fruition over the next 2 or 3 or 4 years, and all of a sudden in the 6-month period we get that price, and we're way ahead of where it should be, and we'll probably cut that back some. We won't take it all, but we'll take some of it off. But I think people forget too that back in 2003, Warren Buffett wrote a letter published in Fortune, and in that letter he said, I've never done this before, but I'm buying foreign currencies now because I think the dollar is going to go down. And then he set up a little idea about how they could issue these certificates that were really a form of tariffs. You want to get right down to it. But people forget about those things. They haven't been around long enough to remember that. And so for us, we're not buying the foreign currencies. We're just buying the gold because we think it'll stay up with everything. It's still the reserve currency. I mean, they can't, even though a lot of the countries are trying to get away from it. I mean, most 68% of things that trade now are traded in dollars. So you have to assume that's probably going to continue for some time. Now, I could see over a 10-year or 15-year period that goes lower and lower and lower. I don't think it goes away necessarily, but I think it does go lower because if you look at the BRICS, if you look at Russia and China and India and Saudi and Brazil, all those countries, they do anything probably to get away from doing everything in the dollar. particularly in the petro area. So eventually they'll probably come up with, if you look at those countries, they'll probably come up with some sort of currency on their own. Right now, there's not enough size. You can only deal in either the euro or the dollar as far as size, and so you just have to see how it comes out. But right now, there's still the currency, and doesn't mean that the currency doesn't go down, though. That's the thing. Well, I just think all of those countries, particularly China too, is saying, hey, we're going to put, if they say, okay, look at them in the last 3 years, all the yuan they put into gold, it's done really, really well. All the yuan they put in the dollar, not so well, you see? So they have to look at things like that. And I think they're deciding that, hey, you know what? We're not going to put any more money in these assets here in the U.S. because they don't want us here. And I think they've gotten that message loud and clear. And so I could see them buying more gold and buying more assets in other places, not the U.S.
According to Oakley, gold has surged to $3,500, driven by ongoing global uncertainty as investors seek safe haven assets and countries such as China and Russia increase their gold reserves to reduce their dependence on the U.S. dollar. Additionally, Basel III regulations have reinforced gold's position in the global financial system, further supporting its demand. While central bank purchases remain a strong pillar in the gold market, demand has slowed from the record pace set last year, according to the World Gold Council's latest Gold Demand Trends report. Central banks purchased 243.7 tons of gold between January and March, a 21% decrease from the 309.9 tons purchased during the same period last year. Despite this decline, demand remained healthy, sitting 24% above the 5-year quarterly average and only 9% below the elevated levels of the past 3 years. The report highlights that central bank gold buying has now entered its 16th consecutive year, continuing a strong trend of accumulation that was fueled by significant purchases in recent years. This persistent demand, though slightly moderated, signals the continued importance of gold as a hedge against global economic and geopolitical uncertainties. Let's get back to the interview.
I think it was camouflaged in the first quarter because what happened is there was a lot of buying by individuals and by companies, buying inventory, they're doing different things, and it looked better than it really was, but they were just getting set up for something to come in this quarter. I think now you're starting to see this quarter, and all of a sudden you're starting to see those things take place. I'm talking about shipping. You look at shipping, these ports, not a lot going on those ports, and they're all issuing reports about that right now. And then if you look at the price of oil is telling you, hey, this economy is slow. And it's always a good harbinger of what's going to happen. And I think Wall Street, though, in their ever-loving quest of stocks, can't see it. And so they just keep on buying, and that really doesn't make it until it finally happens. And then it's too late almost. Well, I think the worst thing since I saw you last time was the fact that if you look at the underlying part of the economy, and that's where shipping and trucking and, and buying things and putting things in inventory, all of that's really tightened up now. And so that is a problem because that's really the lifeblood of an economy when you're moving things around, buying and selling. But all of a sudden, that's coming to a halt or at least slowing down dramatically. And then you have all of these countries, all of a sudden you create a situation where instead of one country disliking you, every country dislikes you. And so all of a sudden you see what happens with all of that. And I think that is just now showing up, but it's going to be there in full force here over the next 1 and 2 months. Well, it's usually a deeper break in the market where all of a sudden everything they've been buying. I'll just give you an example. If you look at if you look at the consumer estimates that have come out in this particular month, okay, individuals were the highest level since 2011, expecting a market decline. And yet in April, they put more money in the market, 40 billion retail investors, than any month in the last 5 years. In other words, they've been so set up to buy the dip since in the last 16 years. They think the Fed will always come to the rescue. That's the way it's been. And so you've had this whole setup here where particularly retail, individuals, I think they're the ones that are going to get hurt the most here because they kept buying it and their advisors have kept telling them to buy it and Wall Street's kept telling them to buy it and they don't look at valuations and all of a sudden and go look at the numbers. We have the most stock. If you look at liquidity in stocks are on the highest now than any time in history by families, anytime. And I've got all the numbers going back, but it's huge. And so they're all in right now, and there's nothing left to happen. But when the prices go down, then all of a sudden you see them really start to do the things that they shouldn't do, which is sell at the low. But that's what happens in this game.
The panic.
We'll look at the market will tell you usually what the companies are doing too. But if you look at the average company that we screen, which is about 250 companies, they're all at the top end of the expense range. I mean, they're expensive. Now, not all of them are, because we own about 25 companies. Don't get me wrong. And we will buy a company, bought one this week. We'll buy a company if it hits a number that we think is going to really work in terms of the next 5 years. And so there's companies that come away with that. But I'm just saying, by and large, if you run a screen on those companies, you're going to have very few companies relative to what you would have seen, for example, at a market low, which will have 95% of the companies are cheap. And you just decide what you want to buy. We're at the other end of that right now. And that's how we look at it. It's not because we're trying to time the market, but if we can't buy something right, we'd just rather hold the money in cash right now and take the 4.25%, and we'll wait on it.
The gold market's surge to historic highs is reshaping global dynamics, with central banks increasingly turning to the precious metal as a hedge against financial instability and geopolitical tensions. As nations like China and Russia boost their gold reserves to reduce dependency on the US dollar, gold's role as a safe haven asset is being reinforced by regulatory changes and a broader shift away from fiat currencies. Despite a slight dip in central bank purchases this year, the trend of gold accumulation remains strong, underlining its continued relevance in a rapidly changing financial environment. Will gold continue to strengthen as a key pillar of global financial stability, or will shifting economic conditions lead to new market dynamics? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.